Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Today I have a very special guest. He is a New York Times best-selling author of the Smartest series of books. His latest book is Wealthier and also Más Rico in Español. We're going to get into that and talk about it. You can learn more about it at wealthierbook.com. His name is Dan Solin. Thank you very much, Dan. Welcome to the show.
Great pleasure to be here. Thank you for having me. I really appreciate it.
My pleasure. We're going to get into your book and all of the great advice that you have, especially for millennials and, people that are underserved in general. But I wanted to just know a little bit about your background, in terms of, I know you're an attorney and some of the work you've done in the industry in general. You're also a registered investment representative, right? At some point. So tell me a little bit about your career path and then what led you to start writing books.
Sure. So I was trained as a lawyer. I went to the University of Pennsylvania Law School, practiced law for many years in New York, and was at one point in my career, the later part of my career, I was struck by how many people were coming to us, investors who were harmed by misconduct of their brokers. I really knew, like most people, I really knew very little about investing at the time, but one of the things I found from trying many of these arbitrations is that I was a genius compared to the brokers who were giving these people advice. I mean, they didn't know anything about investing either. They knew a lot about how to generate commissions and how to act in their own best interest. And so when I decided to transition from getting cases after the fact where there was I had limited options for getting money back to trying to be proactive. And I became formed an investment advisory firm, merged it. And then after doing that, which I really enjoyed, helping people be on the right track to get to financial freedom, then I decided that I could impact more people if I started to write books and said, okay, this is the way to do it. Nobody will tell you this because you can't make money doing this, but basically buy 3 index funds from Vanguard, you'll be fine. And to everyone's surprise, including mine and my publisher, that book was a big hit. It became a New York Times bestseller called The Smartest Investment Book You'll Ever Read. And that started me on my book writing journey, which continues. And this latest iteration of my journey is called Wealthier, the Investing Field Guide for Millennials. I wrote it in English and Spanish because I wanted to really impact a demographic that I think really needs sound and responsible financial information.
Yeah, I love that. Thank you. No, this is something that is very much needed. When I was growing up, I didn't have financial literacy information available in school either. And, and I think it's gotten better. I know that some states are now mandating or requiring, right, that a certain level of financial literacy is taught in school. But something I didn't have. And I know that there are millions of people out there also that didn't. So this is great information. Let's talk about millennials in particular. I know that, one observation I have is I noticed that a lot of younger people now tend to be more attracted to alternative investments, right? Like cryptocurrencies, NFTs and whatnot. I'm not an expert at any of these, so I probably couldn't even do a good job at explaining them. But just in general, why do you think that may be the case where some people are more drawn to that type of investment versus like traditional investing, like in the stock market or real estate?
I think that, millennials are a contrary group, and it's kind of like, I'm not going to do what my parents did. They bought stocks and bonds and got wiped out and over many years, right? They suffered through 2008 and it didn't work for them. It's not going to work for me. And millennials are action-oriented. They believe activity equates to progress. They think that something that's simple and inexpensive can't possibly beat something that's complicated and expensive. So they're very much attracted to alternative investments, which sounds sexy, and NFTs, which I don't understand any better than you, or I'm not sure if I understand it as well. Cryptocurrency. These things sound exotic. They're like shiny objects. And unfortunately, when you look into the data and say, well, what is there's academic data. Finance is a subject that's studied. People have PhDs in finance. There are peer review articles written in reputable financial journals. Very difficult to make the case for any of these. Sticking with sound academic principles of investing, globally diversified portfolios, keeping your costs and expenses low, not buying or selling, very little activity. Bill Bernstein, who's a great author, one of my favorite authors, I quote him a lot in my book, says that he could teach a 7-year-old how to be a responsible investor that would beat the returns of most professional money managers. And I agree. I think investing is simple. Some have said it's simple but not easy. I think it's simple and easy.
Yeah, I hear that most professional money managers don't actually beat the market anyway. So people get stuck paying fees unnecessarily for something they could have done themselves and probably better, right?
Well, there's a great line by Jack Bogle, co-founder of Vanguard, who said, with index funds, you get what you don't pay for. And there's some truth to that, right? With actively managed funds, you don't get what you do pay for. You're paying for outperformance. Over the long term, it is extremely statistically unlikely that you're going to get it.
Yeah, that's very true. That's a great point. I really like that. And yeah, to your point, I feel like slow and steady wins the race, but it's just not exciting, right? It's there's no excitement in investing in low cost index funds and just waiting it out for a long period of time, right?
Well, some people say it's like watching paint dry or, watching grass grow, but it depends. It's very exciting if you set your metric, right? If your metric is, I want to achieve financial freedom. Okay, the trade-off is it's going to be boring. You're not going to be bragging about your index funds holding at the next cocktail party while the other person is telling you how they picked a winner that went up 2,000%, but they never tell you about the losers. So you don't get bragging rights. That's true. It's boring. That's true. But the benefit is you also don't have to spend a lot of time agonizing. Think of all the wasted time people spend researching, watching the financial media, agonizing, buying, selling, consulting. Take that time and go play golf or do whatever gives you pleasure. You should spend like an hour a year on your investments and you'll be fine, really.
Yeah, you're so right. Like in my personal experience as a financial advisor, I also do tax returns for my clients. And I have a handful of clients that I do tax returns only. Like they're not my financial planning clients. They just, I've had them for a long time. And a lot of them, they do a lot of trading, right? So when I get the year-end tax forms, it could be like a 20-something page document, all these buys and sells. And then I just laugh because, I tell them, like, when I go look at the actual realized gain or whatever, like, they're not making any money. I think they're churning their own accounts, paying all these trading fees. And I'm like, you're better off just being, doing something that's more passive, pay less for it, and go enjoy your life because you're really not like doing anything that substantial gains anyway. So I don't see what they're getting out of it other than the excitement.
So you're making a very profound point, actually. Behavioral finance, as you know, is the study of how people's behavior impacts their returns, right? So with investing is like a special category of odd behavior by humans. We don't think, like I study and I write about neuroscience. I'm very interested in how the brain reacts to certain conversational modes. But I would not say, I think I'm competent to just try being a brain surgeon. So if you have a tumor, come to me and I'll see how I can do it. Right. But with investing, people who are successful, say as plumbing supply contractors, they believe they can be successful investors and they believe they can buy and sell. Here's what almost nobody understands this. I hope you'll find it helpful. When you buy or sell, think about it this way. There's somebody on the other side of that trade. And that person, if you're selling or buying, they think you're wrong. They think it's the right time to do the opposite of what you're doing. So now the question becomes, who is it on the other side? So we know that 80 to 90% of all trades are institutional trades. So you're making a decision that you're smarter than Goldman Sachs, let's say. Professional traders who have enormous resources, supercomputers located milliseconds from the New York Stock Exchange. It's kind of like saying, would you like to bet $10,000 that you can beat somebody in a tennis match? And you say, yes, I'll bet $10,000. And you show up and your opponent is Carlos Alcaraz, right? You say, wow, I wish I had known it was going to be him. I would never have taken that bet. That's what happens when you trade. But nobody wants to tell you that, because we have a huge industry that depends upon trading revenue and depends upon pretending that they have an expertise that doesn't exist. Like they can tell you the direction of the market. They can tell you which stocks to buy and sell. But the truth is nobody has that expertise.
Yeah, that's very true. And I think lately I've seen more people being drawn to like the meme stocks as well. Just trying to make that hit that home run out the park right away from the first at bat.
So it's AI stocks. I just read an article. Everybody wants to get into AI stocks. AI is so hot. So I did a LinkedIn post. I said, look, what determines the price of stocks is not yesterday's news. We all know what that news is. It's every publicly traded stock. All information about that stock is publicly available to millions of investors all over the globe. Those people set a price every nanosecond for that stock. That price, we know this from the wisdom of crowds and a lot of data, that price is likely to be a fair price. There are no mispriced stocks. What's going to drive the direction of a stock price is tomorrow's news. None of us know what tomorrow's news is going to be. We don't know whether something better than AI is going to come out or somebody's going to totally dominate that industry. We have no basis for just saying, well, I'm going to take all my assets and invest in AI because that seems hot. That gets us back to boring, which is a globally diversified portfolio where you buy the entire market is the slow and sure way to financial freedom, especially for millennials, which is your audience, because millennials have something that very few people have who are investors, time in the market.
Yeah.
So they're going to benefit from what's called the miracle of compounding. They don't have to hit home runs. They can just hit singles. Just adopt some solid strategies. Just hit singles your whole life. You'll be fine.
Yeah. I love it. I love it. So what would you tell some millennials that either, they're just getting started or don't know how to begin, like in terms of investing and having their personal finances in order? Where should they start?
So I think where they should start, most millennials who are just getting started are saddled with debt of some kind. They have student loan debt. They have consumer card debt, which is very high interest debt. They also may have short-term goals like buying a car or buying a house. They probably don't have insurance. So I would say if somebody's dependent upon you for support, it happens that young people die. About 250,000 a year die, before the age of 40, roughly, I think. I hope that data is correct. But, it's sad but true. So I would say, first, get your house in order. You're not ready to invest. Don't be in a hurry to invest. Be in a hurry to pay off your debts, particularly your high interest debt. And be sure you have adequate insurance, which should probably be term insurance. But you also need disability insurance. You need to be sure, if you're not covered at work, that you have health insurance. Once you're all set, live below your means. When you can, but don't feel badly if you can't, start saving 15 to 20% of your gross salary. Take advantage of a retirement plan at work if you have it. Most retirement plans are not very good, unfortunately. The investment options and 401k plans tend not to be very good. If that's the situation with your plan, what I recommend is invest the minimum necessary to get the maximum match. if your employer doesn't match, you're better off creating your own retirement plan. You can do an IRA, traditional, or a Roth IRA, or a Roth. Yeah, or a Roth IRA. I really like the Roth because I pay now or pay later, and I believe we don't know what's going to happen later. So I would rather pay now and put that money away. And then for investing, I spell it out in my book, Wealthier, the investing field guide for millennials. Basically, just buy 2 low-fee index funds and you'll be fine. ETFs, you'll be fine.
Yeah, I like that. You mentioned the fact that they have time. I think that's one of the, if not the biggest advantage that they have, because they can start sooner and have to put less now away because of the time and the compounding interest effect. And like you said, if they take advantage of an employer match in a retirement plan, it's great. I noticed that a lot more 401ks are now offering a Roth option. What are your thoughts on, people usually always ask me like, hey, should I do traditional? Should I do Roth? What are your thoughts on that?
So my thoughts are take advantage of the Roth option because there's no limit on it. You don't have the same income limitations that you may have, although that doesn't affect that many. Most millennials who are starting are obviously qualify for a Roth. But if you can put more money in a Roth, that's fine. But because that money comes out, tax free. I mean, you're paying taxes now. So I'm a big proponent of Roths, and I think putting money in a Roth 401k is a very good move, especially when you're young. Just be sure you're investing it properly.
Yeah. There's no income limitation. And also you can put 3 times as much as you could in a Roth IRA. So it's a great opportunity, especially when you're first getting started. You might be in a lower bracket to begin with. So might as well just put the money in there post-tax, right?
Exactly.
Maybe you want to reconsider as you start making more money, get married, and maybe in a higher bracket, that might be a different situation. But yeah, absolutely. I agree. I wanted to ask you about, instant gratification. Right now I think we're pretty much all of us are used to that. The fact that we have this magic thing in our hands that with a push of a button, we can get something delivered today, maybe tomorrow, food. I mean, we don't even have to talk to people, right? There's an app for everything.
Right.
So what would you say in terms of a mindset, how can we basically prepare ourselves for adapt to just playing that long game? We talked about a little bit about it not being exciting and not being able to brag about it. Like, how do we say, hey, I'm 24, but I'm not thinking retirement right now. That's like 40 years away.
I wish I could solve that problem. I once looked at an app that would age you and say, okay, Luis, this is what you're going to look like when you're 65. And there's a study that says when you do that, it makes people realize, oh, I'm going to be 65 one day. It's very hard for young people to think way into the future because for all the good reasons you just laid out, we're not even prepared to think about tomorrow. We want something right now. So this is all part of behavioral finance, and it's all part of setting goals, you need a plan. That's where financial planners like you come in. People think, oh, I only need a financial planner if I have a lot of money because they won't take me unless I have a lot of assets that they can manage. But there are a lot of financial planners who will charge on an hourly basis or some retainer basis, and they will give you a financial plan, and that plan will set forth but you plug it into software and it'll say, okay, this is how much you're going to have at various stages in your life. And it will provide for short-term goals. Like you can buy a house at this stage. Let's make that a goal. This is how much money you're going to have to set aside. I think the trick is that expression, you can't get to a destination without a map. I don't think you can get to to financial freedom without a plan. Because the plan is your benchmark. You always come back to it. That's why planners like you add value. You provide accountability and benchmarking, and you have an expertise that not that many people, and a perspective that not that many people have. It's very necessary.
Yeah, I think you bring up a great point, and I'll provide some resources in the show notes. There, you don't need to be super wealthy to start working with a planner. It's kind of like thinking about if you want to lose weight or get fit. You don't need to be fit first before you start working with a trainer. you know, there are advisors out there that don't charge based on assets under management and none of that, and it could be hourly or like a one-time plan fee or something like that, or maybe ongoing depending on your needs, but it's not necessary that you wait until you have money to invest to even speak to an advisor. I think that, definitely the fault of the industry. I think that the relationship with an advisor usually started from having assets to invest in the first place. So then it left a lot of people just out of being able to receive competent advice, period. Right. Yeah, I'll be sure to put some resources of some networks that have planners that charge like either hourly or.
That would be helpful. Like, there are many out there, and what's happened in the industry, as you well know, is that investing has become commoditized. I mean, investing really isn't difficult anymore. So paying people to invest your assets for that particular expertise doesn't, in my opinion, add that much value. What adds value is what you do. Financial planning, that adds value. Tax planning, that adds value. So those are things that are really important. You could pick up any of 10 books. I mean, most books, unfortunately, have misinformation in them, but there are a lot of books like The Little Book of Common Sense Investing by Jack Bogle. Or you can get a book online that's free by Bill Bernstein called If You Can. It's like 30 pages, tells you everything you need to know about investing from one of America's most profound thinkers. And there are a lot of any book by Morgan Housel. I mean, there's a lot of good information out there, but financial planning is a different piece of it. An interesting subject that you must think about a lot is how is AI going to impact financial planning in the future? Because clearly AI is going to be a tremendous help to planners like you in customizing and updating financial plans. I think the future is very exciting. But that's what I would tell millennials to start thinking about. Start thinking about the long term. It's going to come. And when it does, you're going to wake up one day and say, what happened?
Absolutely. Yeah. I tell my clients, like, if you want to buy a car, you can get a car loan. If you want to go to school, you can get a student loan. Right? These are options to finance. If you want to buy a house, you can get a mortgage, right? But there's no retirement loans, so you need to prepare yourself for later, right? So that you have enough to live your life without having to worry about running out of money while you're still alive, right? Because there are so many unknowns, like you were saying. And, I wanted to go back to, we were talking about instant gratification and all that in modern day society. And, the other day I was talking to my wife and I told her, I saw an article that was saying the flip phones are making a comeback. A lot of people are really tired of just having all these apps that are constantly draining their attention and their time and taking them away from their focus. So, which is funny enough, when I was researching you, I saw that you mentioned the cocaine phone and the kale phone. And I was like, wow, this is funny. So if you can tell us a little bit about what those two are.
Yeah, I don't take credit for inventing those terms, by the way. I found them when I was doing research for my book. But time management is a big deal for most of us. And what happens, and I'm sensitive to this because I'm a writer at heart, right? So when I'm writing and I have my iPhone by my keyboard, I can't resist every time the bell. I'm like Pavlov and the dog and the red meat, right?
Start salivating.
I like that goes off and I go down, and then it takes me 10 minutes to get back into what I was doing. It's remarkably inefficient. So some smart person came up with the idea of having two phones: a kale phone, which is a phone that only has critical applications that like emergency phone numbers and things that you really don't want to miss something that's on that phone. And the cocaine phone, which is pretty much everything else, like social media primarily, that's buzzing every 2 seconds as something else goes up on Facebook or whatever. And that when you're working, you just have the kale phone with you. At all other times, you can have the cocaine phone with you. And it's all as a time management technique. Now, I don't do it, to be candid with you. I thought it was a great idea. What I do is I just don't write with my iPhone in the room. And, most of this frenetic activity is completely wasted effort, right? There are very few messages that require an instant response. And most people are posting self-serving stuff about them. It's really not all that interesting. I mean, I think we've just gotten... I find really interesting the latest warning of the Surgeon General that talks about how this fixation that particularly our children have with social media has precipitated a mental health crisis in the U.S. And what I think is missing from that is I think it's a mental health crisis for everyone, not just for our children. I think we're all addicted to it.
Yeah, I could see that, because before you hear the old saying of keeping up with the Joneses. And I feel like now it's in your face all day. Like before, maybe, yeah, you might have seen your neighbor, got a nice car or something. But now you see everyone on social media, right? Like you're saying, they're posting about their latest trip, the meal they just had, the drinks, everything. And, you might think, man, they're doing so much better than I am. Like, what am I doing wrong?
Exactly.
We went to the same school or we're the same age,
Exactly.
And I could see how that could negatively impact your mental health.
And affect your self-esteem. And what they're not talking about is their recent bankruptcy of their business, their terrible divorce, their fact that their children don't talk to them. They're not talking about the negative things in their life. So they select things that they think will put them in the best possible light, put it out there, but it's a very distorted sliver of what's really going on with most people's lives.
Yeah, very true. They show you, somebody said this to me and it stuck out, they show you the highlight reel.
Yeah.
But they're not showing you the behind the scenes stuff. Very true. Another question I had for you, because I thought this might be very helpful for our audience, especially in today's market, right? I've been doing this for a long time, and I used to even do mortgages back in the days. And, 3% mortgages are not the norm, to me, right? Just historically. But some people grew up in that environment where now they look at interest rates, they're like 6.5, whatever they are. And they're like, oh my God, rates are so high, right? And because so many people have the low interest rate mortgages that they're locked into by buying or refinancing earlier, a couple of years back, there's not a lot of supply, right? So it seems to me like prices are still high on homes and interest rates are also high. So a lot of people feel like they're just locked out of the market, right? So their dream of home ownership has been kind of put on hold for now. And I wonder what your thoughts are on the concept of owning versus renting. I know it's an individual choice, but just in general.
So in general, there are obviously pros and cons of owning versus renting, and most of them are well known to your audience, right? I mean, renting gives you a lot of flexibility, and you can move every 2 or 3 years, and there's no big down payment, so you're not, you have more financial flexibility. Owning gives you the pride of ownership. You're building up equity in the house. The other big variable is where are you located? I mean, in some locations like San Diego, San Francisco, mostly in California, the price of homes is so high that it really doesn't make sense to buy for most people. They can't afford it. And even if they could, the rent buy ratio is just out of whack. But if you live in most parts of the country, this is my bottom line on rent versus buy. The data is really quite clear on two conflicting data points. One is if you rented and invested the difference, you would do better over time. That data is pretty clear. If you invested in an S&P 500 index fund, looked at all the historical data, you would end up with more money. But the data is also clear that I've never met anyone who's done that. And I think very few people actually do that. They end up spending the difference,
Yeah,
right?
rent and spend the difference.
Rent and spend the difference. Okay, so there are studies, conflicted, of course, by the National Association of Realtors, that says that people who own homes end up with a significantly higher net worth than people who rent homes. And this is particularly true of lower income people. So what I tell people is what you're really concerned about is, it's a bad expression, terminal wealth, meaning how much money do I have when I'm about to retire? If you can possibly buy a house and meet those obligations and not default on your mortgage, you will end up with more money. So if you live in an area where it's possible to do that, even though it may not be the absolute best investment, I wish you would do that because I think you're going to end up better off.
Yeah, that makes a lot of sense because mathematically, yes, if you rented and actually invested the difference, you'll be better off. But how many people actually do that, right? Life happens all the time. And then that money is just so easily available that it just gets rerouted elsewhere. That makes a lot of sense. Thank you for that. Yeah, I appreciate it. So, Dan, I wanted to ask you one final question. So first of all, before I let you go, where can people learn more about you, the books, and if you're on social media and so on? I'll put the links in the show notes as well.
So the website for the book is wealthierbook.com. It's available in English and Spanish on Amazon. Thanks for that. Great. And everything about me is on the book's website is quite comprehensive. It has endorsements and reviews, and we'll tell you pretty much whatever you need to know about the book.
Okay, excellent. I'll be sure to share the link for wealthierbook.com. So one final question. You are in an elevator and a stranger comes in. You're going to be sharing this ride for, maybe 30 seconds or so. They don't know your name. They don't know your website. They don't know about your books. And they ask you, hey, what is something that you can share with me that would better improve my life, whether it's financially or otherwise? What would you leave them with?
How many floors are we going up?
Let's go up 20 floors. Let's say you're in Las Vegas going up to the resort after your conference.
I forgot that you were in Las Vegas and have already computed the odds.
There you go.
So I think what's really important is to ignore the financial media, that the system is rigged against you as an investor. And as you put better than I did, Luis, slow and steady wins the race. Investing is not complicated. Buy a couple of ETFs and then forget it. Go enjoy your life. That's what I would pretty much tell anybody who asks. Get out of your own way. The other thing I think I would like to leave your listeners with is you kind of need I know this sounds intimidating, an intellectual framework in order to invest appropriately, because your behavior, I always say, get out of your own way. I mean, your behavior is going to control almost all of your returns, in my experience, right? So I have a chapter that I really enjoyed writing in the book about Stoicism. And you need some intellectual framework like Stoicism, like I understand what I can control and what I can't control. I'm going to make a list. In the investing, this is what I can control. This is what I can't control. I am not going to obsess over things I can't control. I'm going to stay focused on things I can control. It's a great philosophy for investing and a better philosophy for life.
I love it. Absolutely. Thank you so much, Dan. This has been great. Everyone, be sure to visit wealthierbook.com. Check out Wealthier, also en español, más rico. I'll put the links in the show notes. As always, if you have any questions, send me an email, luis@onmywaytowealth.com. And I'll see you in the next episode. Thank you so much, Dan.
Thank you, Luis. It was a pleasure.
Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation.